Our portfolio is fairly diverse. Currently in the portfolio, we break down the kind of collateral backed buckets into a number of different areas. We currently have about 55 different loans in the portfolio within our asset-based lending, asset-based lender finance, and specialty finance type categories. We have just under 100 factoring transactions, and then a few more lender finance facilities to a franchise division of Garrington Group called Liquid Capital, which are also lender finance type transactions. So fairly diversified, portfolio through a lot of different funding solutions. Fairly evenly broken down between Canada and US historically. I would say that going forward, we might see a slight bias towards a little bit more on the US side than in Canada. But thus far in the past almost 8 years, it's been fairly evenly split. We have a fairly broad exposure. So a lot of people see us as a Canadian player or a regional player in the US. We're quite broad. We currently have clients in over 33 different states and 6 different provinces in Canada. And that's been fairly consistent for quite a number of years now. And, as I mentioned before, we're primarily, first lien lenders. It's 87% of the portfolio on a dollar weighted basis, is first lien. It's hard pressed to typically get us to go into the second lien, but if in rare circumstances where we like the deal, or we come in with a mindset where we might take out the first, if push comes to shove, we might get comfortable getting into that position. But you can see us as primarily a first lien lender. With regards to the types of loans we put on, the one thing I would say is that, we are on the shorter end of the lending spectrum. So, a typical term for us is a year, maybe out 2 years, on some facilities. That being said, we have just under half of our portfolio is floating rate in nature. We have made a conscious effort over the last 2 to probably 3 years to put out most of our loans on a floating rate basis. That said, we do have some legacy clients, that we continue to roll with a fixed rate. In some loans that come in that are expected to be shorter date, sometimes we do it as well. That being said, a significant portion of the portfolio does turn within a year. So it's not like on the fixed side, we're locked in to those rates for an extended period of time or anything. On a loan to value ratio basis, it really depends on what the asset is and what the company is. But when you work it out on a dollar weighted basis, within the portfolio, current LTV sits around 56%. I'm the first one to caution investors about the V in LTV. There's a lot of different ways of calculating it. And there's in our calculation, there's quite a bit of things that are not included, what we consider, say, boot collateral, which don't go into our calculation, but could be value within the company that we would still have a lien against, those sort of things. But for another discussion. With regards to, our duration of loans, well, like I mentioned, we are on the shorter end of the lending spectrum, currently on a dollar weighted basis. The term to maturity is around 9 months currently.